Hey everyone, thanks for joining us on our next episode of WP Talks. I'm Tom Rein. I'm the director of our WP Wealth Group here at Whitley Penn, and really what we do at WP Wealth is work with our clients and supporting them on their accomplishing financial goals, which encompasses a lot of things. Most importantly today is dealing with the volatility of the stock market. So we're going to spend a little bit of time today talking about our clients and how they are maybe reacting to this volatility.
Tom has graciously allowed me to come along for the ride. This is Bill Weston. I'm a manager here at WP Wealth and joined the team about 3 years ago. So we have a few canned questions, but I think we'll let the dialogue take it from there.
Yeah, I think the first thing is how should investors react to the current uncertainty in the economy and the capital markets? The coronavirus is causing a lot of concern with investors, and obviously at WP Wealth, that's who we deal with, are folks that are invested in capital markets. And so when we get this kind of disruption and volatility, obviously it creates a lot of anxiety. Bill, I'm sure you've had clients that have called you or reached out to you in the last couple of weeks with concerns. Maybe just share a little bit about what some of those comments or topics are focused on right now.
Yeah, I think a lot of them are in disbelief, really, that something like a healthcare pandemic is creating this chaos. But getting back to the core of how we work with clients, we're very plan-centric. And so from the initial stages of onboarding and working with clients, it's more of a reminder that letting them know that even in facing situations like this, we're prepared for it. And reminding them that we don't just own the stock market. There's a lot more that goes into this than just the volatility and the wild ride they're seeing on the news each and every day.
Yeah, that makes sense. A lot of the calls I'm getting or emails center around what should we do? Something, in their minds, something has changed all of a sudden, that, it's a different world and different environment. And even though that we've worked with them for years and have plans and strategies in place, that all of a sudden maybe something different should be done. I think that's really interesting because we spent a lot of time in doing due diligence and working with our clients and building plans that the plan has a time frame of whatever the financial goals are. And it's interesting how once you get a little bit of fear and emotion involved, that all that planning and those time horizons all of a sudden kind of go out the window, and everything is much more relevant on a today basis. I don't know what you do, but a lot of the communication that I've had recently with clients, again, is going back to, what is the plan? What is the time frame for whatever the particular goals were that we were establishing with them? It's interesting if we had a client that had a financial goal, maybe, college funding, and they were a couple of years out from their child going to college, the risk portfolio and profile would resemble that time frame. It would be very conservative, probably very little equity exposure. So to hear concerns about what do we do now, the answer back to them is, well, we've anticipated this. This is consistent with what the time frame for the goal was, and we're not carrying a lot of risk exposure. And I think conversations like that kind of put the clients at ease and alleviate some of the concerns. And you probably have had similar experiences in the last few weeks as well.
Yeah, absolutely. And I think also starting with that plan focus and reminding them of why we positioned ourselves this way. But I think something that's been top of mind for a lot of investors has been related to the decline in interest rates, but also the correlation of asset classes that seems to have taken a hold of capital markets over the past few years. And what I mean by that is we've seen fixed income assets that have traditionally been your safer positions move in tandem with equities. And I think that's put the question in a lot of investors' mind is this diversification that we're providing within the portfolio, is that still going to work for me? And so part of some of the conversations that I've been having is showing these investors that, yes, this positioning has worked for you. It has provided that element of security and diversification that you were looking for, and is going to help insulate your portfolios through this volatile period.
I think it's interesting. Clients, investors, historically would want, a nice, smooth and steady growth of equity values year in and year out. And the reality is that's not how capital markets work. As you and I know, that to get any type of expected return greater than what you could get from a no risk or zero risk investment, some level of volatility is absolutely required. Otherwise, there would be no risk premium in investments. And unfortunately, what risk really means is it means volatility. And certainly we're experiencing that now more than ever. So it's our job to continue to remind clients that to get any type of premium return on their investments, then volatility is absolutely a requirement. And sometimes they lose sight of that, and sometimes volatility is a lot more to bear than what is ideal, but it's absolutely necessary for them to do that. The compounding factor, and I think you touched on it a bit, is that we're in an environment where returns on all asset classes are moving in the same direction, which traditionally doesn't happen. A certain asset class tend to move in opposite directions. So whether it's been a matter of all the liquidity that central banks around the world have been forcing into the marketplace, or whether the United States, both bond and equity markets, have been deemed to be the safest place relative to anywhere else in the world, and attracting a larger proportionate share of capital flows, the bottom line is that everything has been moving in tandem. So it adds a little bit of extra concern. In most recent days, we've seen added to the coronavirus, also the oil shock, where we've got foreign players in Saudi Arabia and Russia that are kind of flexing their muscle and trying to influence certain outcomes. And so on top of an already concerning coronavirus effect on economic conditions, we have this shock to oil and gas, and so it's compounding things. And I think that maybe leads into the next topic, which is, what type of an advisor should a client work with, and what is the difference? We typically label those in broad categories as fiduciary and non-fiduciary type of advisors. We at WP Wealth work as fiduciaries, and I thought maybe, Bill, just share a little bit your perspective on what is the difference between the two advisors and why one would be better for a client than another.
Yeah, so here at WP Wealth, we're a registered investment advisor, and so that means we are a fiduciary. We have a fiduciary obligation to work in the client's best interest. How that differs from a number of other money managers and financial advisors out there is they aren't held to that same fiduciary standard. Another, dimension to that is working as an RIA. That opens up the entire investment world for us to look at, consider, implement for our different clients, and really allows us to act in that true fiduciary capacity. And looking at those that don't have that arrangement, it's not necessarily the individual that is put into question. There's a number of financial advisors out there that may not even be bound by that fiduciary standard, that are still trustworthy and would be worth considering in managing your assets. It's more the greater broker-dealer that may have a different agenda and may force the hand of some of those advisors, whether it be suggesting a particular product that may be proprietary, or just giving direction that wouldn't necessarily be consistent with the individual's goals.
Yeah, and I think I think that's very true. The way I differentiate the two types of advisors and advice really kind of focuses on a fiduciary is really somebody that's going to sit on the same side of the table with the client. So ultimately, they win and are successful when the client wins. Sometimes the definition of winning as it relates to our world of wealth management is not necessarily in the rate of return that you might get on your investments, but more times than not, it's accomplishing a financial goal. If you're not a fiduciary, if you're working with somebody that is not necessarily under the guidelines of fiduciary standards, more times than not, those relationships tend to just focus on investments. And if that's the case, what we know about capital markets is it's very difficult to forecast in the future, what's going to happen to a particular investment or return. And so if my relationship is solely focused on market performance and we run into a volatile time like now, I might get stuck in providing advice that isn't central focused on goal attainment for the client. And I think being a fiduciary, spending the time and the due diligence to try to understand what exactly our clients are looking to achieve allows us to build comprehensive plans that clearly align the risk that a client should and are willing to take, and so that when extreme times like this present themselves, it enables the client to stay in their seat and not react to it. That may not necessarily be true of a relationship that's formed and bound in a different philosophy than a fiduciary relationship. So I think both knowing, as you mentioned, knowing that the person making recommendations are doing it for the client's best interest, and then also kind of reiterate what I said is having a foundation that's based on planning. I think especially in extreme times like now really keeps the client in the seat, and it enables them to stay for the long haul to accomplish their ultimate goals. So I think that's a really clear or important distinction that those that aren't familiar with that terminology would look to as they evaluate and search out potential wealth advisors. And so I guess the next question, and maybe which is the pertinent question today, is given the volatile nature of the market, what are the opportunities if a client is has a long enough runway before their goal, or has some liquidity, or has some ability to take risk? What opportunities present themselves in volatile environments like this?
There's maybe not necessarily the opportunities that we like to see, but there is still something that can help add to the bottom line at the end of the day. There may be some tax loss harvesting opportunities. There may be an opportunity for a more general rebalance and to get the portfolio back in line. There may be a greater household rebalancing and asset location opportunity that will be available to the client. So even though volatility can create a lot of stress, it does open the door for some different planning opportunities for the individual.
Yeah, I think you're right on that. And I think the other thing, having the advantage of being in wealth management for a handful of years like I have, and WP Wealth started offering wealth management services to our clients about 2000, the year 2000. I've seen several pretty extreme times in the market, and what I know for sure is that in 100% of the opportunities where we've seen extreme volatility on the downside, at some point in the future the markets reach new highs. And so we have that confidence in capital markets to be able to communicate to our clients that if they're fortunate enough because they've got enough number of years before their goal is a reality, or they have some extra liquidity, or they come into money through a bonus or through other sources, and you have discounted buying opportunities like the current environment's presenting us, the probability of recognizing a significant rate of return into the future is much higher today than when you're exposing new capital at all-time highs. And so it's our job as advisors and as fiduciaries to our clients to kind of clear the noise and kind of get away from the headlines that are disruptive a lot of times and really focus on core principles in order to guide our clients to what we hope to be, successful long-term outcomes. And so I think this was a topic that we felt like needed to be addressed now. This is our first WP Wealth episode on WP Talks. We look forward to bringing you other ideas in regards to planning and working with fiduciaries and some of the other things that we do here in supporting the clients of the firm. We hope that some of the things we talked about will maybe ease some of the apprehension that you as investors are feeling today. We may not be out of the woods yet. Typically, volatile periods don't come and go in a week, but we hope that we've given you some things to think about. And look for us on future episodes at WP Talks. And thanks for listening today.
And if you aren't already, make sure you start following us on LinkedIn at WP Wealth, where we'll continue to post updates in between our podcasts on all the topics that we've discussed today.
Thank you. Have a good afternoon.